Welcome to the Political Risk Podcast, an independent podcast focused on geopolitical risk, serving decision makers in specialty insurance markets, reinsurance, and beyond. I'm your host, David Benyon, and I'm joined by James Kench, Head of Insurance at Kita. Kita is a Lloyd's market MGA. It insures carbon markets, and James himself is based in New York. Carbon markets are seen as a vital pillar of efforts by governments and companies alike to reach net zero and to curb climate change. Now, one thing about carbon is that most of the investment is coming from the Northern Hemisphere, from the West, while so many of the projects on the ground are in more politically exposed countries in the global South. Carbon is tipped to be the next cyber as an avenue of growth for the insurance market. And quite simply, without insurance to underwrite all of these projects and their risks, the carbon market cannot hope to reach its trillion-dollar potential. Now, James starts by giving a superb walkthrough, explaining how the carbon markets work, defining some of the terminology, and providing some key figures in the market's growth trajectory. As you may guess where all this is going, which is that Kita has a brand new political risk product that it's launching, which caters specifically for carbon markets. So, let's get on with it. Well, James, firstly, thank you for joining me. Pleasure to have you on the podcast.
Pleasure. Thank you for having me.
Now, James, please would you give us your introduction to Kita?
We're structured as a Lloyd's cover holder. Our mission is how do we use insurance to de-risk high-quality carbon projects. So we're structured as an MGA so that we can partner with the great insurance and reinsurers, capital providers, so they can deploy capital into what is a very new, emerging, evolving space. Our capacity providers are Chaucer, who are our lead partner, as well as Munich Re and Renaissance Re, who are just fantastic partners. We partnered with them as we came through the Lloyd's Lab process, which was great.
You insure carbon markets, carbon capture, carbon storage, and supporting the transition to a low-carbon economy. For those people who don't solely work in carbon markets, could you just provide a bit of an introduction to what carbon markets are, their evolution, and perhaps even growth forecasts going forward?
So when we think of the carbon markets, there's two elements to the carbon markets. There's the compliance markets and the voluntary markets. The compliance markets are an existing system that are out there in the world at sort of state, regional, federal levels to different degrees. They're a regulated market, and they're either a sort of tax structure or they're a cap and trade system. So the big examples of the cap and trade system would be the EU emissions trading scheme or the California cap and trade scheme. And that's geared towards heavy emitting industries and trying to incentivize them to start to decarbonize and reduce their emissions by setting a cap on those emissions, which will gradually decrease over time. And if I'm in danger of emitting too much, then I have to purchase from another emitter any excess allowances that might be sort of tradable. And that's a way to kind of price in the emissions that they're putting into the atmosphere. The voluntary market is not regulated, and that's aimed at giving corporates a tool to offset some of their hard-to-abate emissions. So all well-meaning corporates are building net zero strategy, i.e. how do we avoid emitting in the first place? How do we reduce our emissions? And then how do we make sure we, on a net basis, we are not emitting carbon into the atmosphere? And a tool to do that is through carbon credits, which are issued and traded and used by the voluntary carbon market. Both markets are relatively modest at the moment, but there's expectations that they're going to grow pretty drastically. And that's just because the scope of the challenge in terms of the climate maths out there is pretty stuck. We need to be removing actively between 5 to 10 billion tons of carbon per year from about 2050 onwards. And that's just an unfortunate fact that we just have done sort of too little for too long in terms of decarbonizing the economy. Therefore, removing that amount of carbon by 2050 is just a massive, massive scale up for society and corporates as a whole. And therefore, the forecasts for the market are pretty big. So to get to, say, 10 billion tons of carbon being removed would put carbon as a commodity in the same sphere as some of the existing fossil fuel industries. Coal, oil, gas are in that sort of 3, 4, 5 billion tons per year, and carbon needs to get to that scale. And then there's a rough expectation. It's hard, obviously, to predict that far in the future, but there's a rough expectation that the price of carbon would be around $100 per ton. So 10 billion tons, $100 per ton gives a potential sort of annual market of about $1 trillion, which is massive. The voluntary market is a $2 to $3 billion market and will be needing to scale up to that level. The compliance markets are actually an 800 billion market, but they're not actually removing carbon like the voluntary markets. The compliance markets are a scheme to incentivize decarbonisation, but they're traded and issued either via tax or allowances, whereas the voluntary market are actually projects that capture atmospheric carbon and store it in some form or avoid the emission of carbon to the atmosphere. And that's quite a key distinction. The other distinction in the carbon markets is why are corporates or investors having to participate? So if I'm not regulated, if I'm not a heavy emitter that is subject to some of these emissions trading schemes, then the corporates are thinking around it in terms of how do I achieve my net zero strategy? And there are also investors and traders who are seeing carbon as a new sort of asset class, a sort of commodity class that either they want to build funds to speculate in on their own account or on behalf of their investors.
For these projects that are removing carbon from the atmosphere, they can be of various types, right?
The main distinction is between what are called nature-based solutions versus engineered solutions. Nature-based solutions would be sort of the classic example of reforestation. So planting trees, they grow. As they grow, they're capturing carbon and storing it in their trunk, or protecting existing forests that are out there from being cut down and that land being used for sort of agriculture or something else. The engineered solutions are an emerging kind of tech-driven way of capturing carbon. They can either be through mineral processes or chemical processes. The main sort of few that are emerging at the moment are something called direct air capture, which is where you physically can suck carbon out of the sky through these so-called sky hoovers and then store it underground. But there's also some other technologies like something called biochar and something called enhanced weathering. But suffice to say is there's lots of different ways to capture carbon. And there are many firms that are sort of innovating and building out the technologies and trying to scale them up in this like really, really short window of time that we have over the coming decades to meet those sort of 2050 goals and beyond, to not only slow climate change, but also in the future kind of reverse it.
James, please give a brief explainer of the flagship product that's led to the new political risk product that you've got. So the carbon purchase protection cover product, which protects carbon credit buyers against the risk of carbon sequestration should projects fail to deliver expected volumes of carbon credits. There's quite a few terms in there that probably need defining.
Yeah, sure. So a carbon credit is an intangible asset that represents 1 ton of carbon that has been avoided, reduced, or removed from the atmosphere. And they're derived from some carbon project somewhere, either the nature-based or the engineered projects that I mentioned that has done so. Carbon sequestration is kind of the act of capturing carbon and storing it in the atmosphere. So that would be where carbon has been removed by one of those means. Our approach and the big challenge we saw in the market was, because there's lots of carbon projects out there, there's lots of different types of credits, but they're not necessarily all have been perceived as of high quality. And there has been some reporting on whether these projects actually did what they said they were reporting to do, and some projects haven't been run too well. So therefore, there's quite a sort of reputational risk for any corporate that wants to purchase credits as part of their net zero strategy, or any investor looking to invest in this space to say, well, how do I know this is a good project? And there's quite a lack of supply of high quality projects out there. So therefore, the way they get around that is to say, well, I know I'm going to need all these credits and I want them to be high quality. I need to lock in that supply of credits by either doing a pre-purchase, so doing a forward purchase of credits, or by making an upfront equity investment into a project for a future stream of credits. And in both instances, I'm sort of putting money up front now for a future delivery. I'm prepaying for carbon, but I may not get that carbon because the project may fail. So we built the carbon purchase protection cover to cover that risk, and therefore give the investors the confidence to put their money down, knowing that if they don't receive the carbon in 1 year, 3, 5, up to 10 years in the future, then the insurance is there to sort of protect that downside risk and to make them whole. And we can do so with a payout in cash, as you'd expect, but also a payout in like-for-like carbon credits, depending on what is important to that particular insured at the time they make that purchase.
Which leads rather neatly onto Kita's new political risk product for carbon markets, responding to the reality that so many of these carbon projects are taking place within frontier markets in the global south.
Yeah, at a macro level, the political aspect of carbon is sort of twofold. So there's your classic political risks that are out there for any industry, nationalization, expropriation, etc. There's nothing new for carbon in that sense. I think the nuance for carbon is, like you said, a lot of these carbon projects generally tend to be in the global south. That's where there's more land area. And also just by virtue of the climate and the weather, trees tend to grow faster and capture more carbon in the global south. So that's where the bulk of those projects are. The nuance for the carbon markets is there's still an evolving mechanism as to what are the rules of the road for a project developer to follow. There was a plan and a goal for these rules to be set at the kind of global level by the UN. And the UN are still working on those, and they discussed in detail prior to the last COP. There's still an active working group trying to kind of refine what that looks like for the coming COP. But in the end, the framework was set, but the detailed implementation was kind of left open to the countries. So that brings the risk that any particular host country, as they're called, will define for any carbon project within their borders, what are the rules of the road? How are these projects going to be given the license to transact, the license to export the credits, at what rates and at what terms? And then there's also a slight complication around how these credits are accounted for at an international level. And this also brings a little bit of a nuance to the carbon market. So we've been talking so far around a net zero strategy for corporates and investors, but also governments and countries have their own net zero strategies. And it's what's called nationally determined contributions. So each country will have basically a net zero strategy, or will be working on a net zero strategy, and it will have its targets that it needs to meet. In order to do that, it will need to sort of work on decarbonizing its economy as much as it can. And then it may also be able to track what's going on within its borders in terms of some of these carbon projects. And then the risk is that if I'm a host country and I want to be able to reach my country level net zero target, will I need to call on the sort of natural capital resource, these carbon project resources within my own borders to meet those goals? Or do I think I have a surplus and therefore I have an asset that I can trade and generate some revenue from by allowing them to be sold internationally to corporates in the US, North America, EU, etc. And then the risk that this brings is if I allow, I'm not speaking as the government, if I allow those credits to be sold internationally, I can do so on two dimensions. Either I just sell them without what is known as a corresponding adjustment, or I can sell them with a corresponding adjustment. And the corresponding adjustment is basically that sort of accounting ledger process to cancel out what those credits could add up to within a particular country's borders, or does that kind of accounting transfer to the host country of the purchaser of the credits? So that brings this sort of quite a little bit of nuance and complication for the carbon markets, and the exact sort of rules and frameworks around those corresponding adjustments, how they're going to be implemented, and whether corporates are going to require that the credits they purchase need those corresponding adjustments or not. And one key complication has been the voluntary market is one that isn't regulated, but there are several industry groups that are kind of setting what some of the priorities could be. And a key one is the International Airlines and sort of aviation industry regulator that manages what airlines will be allowed to use to offset some of their emissions. Obviously, flying is one of the industries that's always going to be hard to abate, and therefore these carbon credits make sense to offset those hard to abate emissions. And the guidelines that international aviation body is trying to push is that airlines should, or folks that are covered under these guidelines should be purchasing credits with a corresponding adjustment. So that's driving or seen to be as a potential market driver for credits being sold with this particular corresponding adjustment, which therefore brings into that risk of understanding at a host country level whether they're going to be able to meet their own net zero targets. And is there a risk at some point in 3, 5, 10 years down the line that I'm country X, I thought I was really on track to being able to meet my net zero strategy, but alas, I haven't been able to decarbonize as quickly as possible. I'm sitting on this sort of potential easy resource of carbon credits that I had planned to sell internationally, but I'm afraid I'm going to need to use them for my own net zero commitments. And therefore that sort of political risk comes in. Would some of these projects become nationalized? Would licenses be cancelled? Would previously existing investment contracts be ripped up or changed beyond what was initially planned? And that brings uncertainty for all these corporate investors. We're trying to sort of figure out how do they be good actors? How do they invest in a good, high quality project, but still be aware of this risk, that could undermine that goal? And since there's a massive lack of supply of high quality credits, there's a concern on that sense that folks that are looking to be proactive and lock in that supply, then don't only have to worry about the physical risks of a particular project. Are the trees going to grow as expected? Is there going to be climate related risks that endanger the forest, or is there going to be land use changes? They also have to think about the political risks that may be awaiting them in the short to medium term as well.
So how does this work relative to typical political risk products, but particularly for carbon markets?
I mean, the way we think about it, we think classic political risk is really well suited for the carbon space. I think the key two things to think about is, one, there needs to be an extra layer to understand what those additional risks around revocation of licenses and this challenge that the government isn't going to meet its own net zero targets that could cause it to renege on those contracts. And then there's a little bit of a nuance around those sort of corresponding adjustments I mentioned. But the key challenge at the moment is, in order for this to be insurable, as any experienced political risk underwriter will know better than me, there needs to be quite firm investment contracts, very clear rights of recourse and remedies for when things get wrong. And at the moment, the carbon markets are not quite there. There's a lot of work going on at the moment to build in more robust templates around these structures, and also to get what are called letters of authorization from the host countries, i.e. the host country provides a letter to a particular project developer that it supports that project and what it's planning to do in terms of capturing carbon and issuing credits. The challenge at the moment is those letters are not really robust and sort of contractually enforceable as we would like to see them, so that the traditional PRI market can get comfortable with them as they would for, ignore carbon, but, providing PRI for any major investment in a mine license or something like that. Carbon needs to get to the same level of maturity, and that's the challenge for the market. But in the short term, there is opportunities case by case, sort of deal by deal, as more of the discerning institutional investors that are used to working in these countries and understand the political risk market, they're already building in those types of contracting structures, and then therefore traditional political risk covers like CND, contract frustration, forced abandonment, license cancellation, PV, they can all be applicable because the underlying investment contract and structures are reasonably familiar. The nuance on top of that is just understanding how the licensing around credits will work, how the carbon rights to particular projects would work, whether these letters of authorization, how robust they are and how interlinked are they with the investment contracts, and then around that corresponding adjustment piece that we talked about already.
For the PRI products in particular, who have you got providing the capacity?
Yes, we've been working with TMK on this one, who are great partners, a really deep expertise in the PRI space, and have been very great partner in helping us kind of challenge our thinking around what are some of the carbon risks, but how do we translate those into political risks that the rest of the market is familiar with. And the goal there is that we see our job having one foot in the carbon market and one foot in the insurance space, is we need to educate the carbon market about how insurance works and help them understand what good structures look like, what does good look like from an insurability standpoint, so that more capital on the insurance side can get comfortable with that risk. And that's really important because the scale up that we need for the carbon markets is going to be pretty daunting. So we need lots of well-informed risk capital out there to support these projects. And then same on the insurance side, part of our role is to help raise awareness of the carbon markets as an opportunity, but also understanding what are some of those nuances of the risks. And therefore, on the larger deals, when it comes to syndication, there's lots of willing, sort of friendly markets to collaborate with to help get that capacity that we need for some of these bigger deals that are coming down the pike.
But you said the carbon market is still evolving in relatively early stages, but some of those existing political risk insurers themselves might not be willing to deploy capital to meet client demand because this is a sector they don't know very well, or the risks are different. What would be the reasons that they might not step in?
I think that's it. It's quite an unknown space. It's a really relatively nascent market. It's a relatively small market. So is it really worth that much attention from a existing PRI market that they've already got a good portfolio, good client list? Maybe necessarily don't need to be hunting out for something that's kind of maybe perceived as weird and wacky for now. But so we're just trying to raise the flag to say, well, actually, this is going to be a pretty large opportunity. And the way we think about it is to understand these risks, there's a few kind of layers. There's obviously the political risk, and I think that's obviously well understood, and there's great tools and indices and rating models out there already. I think the challenge then is just to overlay some of the nuances of the carbon space. We see there being sort of three key layers, and this is where we're trying to focus on. We've built a sort of rating model and index around those layers that then we can kind of factor or overlay on top of that base political risk. So those layers are around what is a particular host country's maturity around its approach to carbon. So what are the existing national frameworks, contracting structures, legal frameworks around that? And that's a really emerging space, as you can imagine. Then there's that country's net export capability compared to its net zero goals. So trying to put in some data and statistics behind what is the likelihood of a particular country having to renege on contracts around carbon because it's not going to meet its net zero commitments. And that's a very emerging space. Different countries are either very clear or not very clear on this to different degrees. There's many different types of projects that could be within scope, and they might sort of have different commitments for different types of projects. So it's trying to be able to map at a really quite minutiae level, what are those risks per country versus the project that we're looking at insuring in question. And then the last kind of layer of context is sort of the bilateral and multilateral treaties that might be in place. So is there sort of multilateral bank involved, which would be great? Or if not, is there an existing bilateral treaty with, say, Singapore as a nation with the host country in question? And that presumably may provide a little bit of comfort that if a country is going to renege on some of its carbon commitments, then it might not do so where it has a sort of bilateral treaty with a particular other host country, normally from the global north, that has en masse is investing quite a lot into these types of projects. So we're seeing, for example, Switzerland, Singapore, and Japan have been very active in this space, building out bilateral treaties across the globe, trying to kind of map out this opportunity and giving a little bit of a framework for itself at a national level, but also providing perhaps a little bit of cover for the corporates domiciled there to do the same. But the real challenge is, how do you quantify that net export capability? That's where we think we can bring the value, as well as just being really embedded into the carbon space and guiding both the carbon markets and sharing our 2 cents, as they say, to the PRI world on what we're learning and how do we help continue to define what good looks like on both sides of the house.
And of course, insurance can unlock some of the potential for would-be investors within the market. It's just warming up, so to speak.
I think this is where insurance has a critical role to play, because we speak to tons of investors and corporates who are wanting to act and they're worried about these risks. And so far, there hasn't been a product or much interest from the insurance sector, or they just assume that insurance will want to cover this stuff because it's so new. So they're always super relieved and strangely excited. It's weird to be in insurance and have people that are excited to talk to you, but we're in that space right now.
And that's all for this episode. Thanks for listening. I've been your host, David Benyon, and I'd like to thank my guest, James Kench from Kita. Production was by Peter McGill, and Lawrence Durkin made the music.